back to Anybody Can Trade ABCT. This is my weekend special video which I have started for educational purpose. Hope you all are having a nice weekend. So this weekend topic which I am covering is, as you might have seen in the beginning, I am covering the options trading, starting with basics. So if you know, you might have heard a lot about options and futures and all. Options and futures are nothing but the derivatives of the index, or you can say any stock or any script. So why I have chosen options is options trading is one of the popular, and this option trading is done with the help of even lesser capital also. Whereas that too in options mainly options buying. So that is why I have chosen options, and also I am going to cover how to do options buying also with which requires less capital. So let's begin with our options, basics of options. So there are two types of options. One is called a call option and another one is called put option. CE, call option is called CE. YE means when options were introduced to Indian markets. Actually, the options were already as a derivatives were traded in American market also and European market also. But when it was decided to implement in Indian market, so we actually uh, took European market options data as like knowledge as our data. So that is why it is called CE, call Europeans and put Europeans, kind of like that. So that is why we call it CE and PE. So these are nothing but call option and put option. And the price and how we judge our options, what is call option, put option is like when the market is bullish. So if you think the market is going above, suppose Nifty is around now 18,500, and tomorrow if market opens and if you think market is going to be around 18,600 or 18,700, yeah, then one can buy option, call option. And if suppose tomorrow, if market Nifty opens around 18,500 only, and if you are thinking market is going around 18,400 or 300, then you can buy put option. So this is how option buying works, and this is how call option and put option. And if one suppose tomorrow if market opens and it remains flat to bullish, like it opened around 18,500 only, and it is revolving around 18,550 to opened, and it went around 18,550, 580 like that, and it is in the range for the rest of the day in the same range, then in such situations option selling is done when the market remains flat, means there is no much movement. In such situations usually option selling is preferred, but again option selling requires large capital. So that is why I am going to cover only option buying points in this series. So coming to option buying only, so you need to refer to only these two. When market is bullish, call one has to buy call option. When the market is bearish, one has to buy put option only. So this is the another nickname you can call. You can say the nickname for call option buying is called long call, and the nickname for bearish put option buying is called long put. So the price we pay to buy an option is called options premium. That like I am going to buy a call option. So I am buying 18,500 call option, means I will be paying some price for that buying for that options. So that price is called options premium. That I will explain on the this option chain chart also, like what is option premium and where you can see and all. And when the price at which index or script is currently trading is called strike price. Like example, I'm continuously taking one example, like market is around Nifty is around 18,500. So if it is tomorrow also opens at the same level, then if we are I am going long, then the strike price which I choose is called the price the which I choose is called the strike price. The price at which index is trading like 18,500 it is trading. So I am going long. So I am going to buy 18,500 C example. Then it is called 18,500. C is called the 18,500 strike price. So let's move on to our option chain chart. So in this, I will show you how to open an option chain also. Suppose if it is you are using Zerodha as your trading platform, then if you just click on this three dots and you just click on this option chain, here you will get option chain data. So see full screen. If you make it, then here you will get the option chain data. So this is our Nifty chart. Here you can see market is closed around 18,500, so 18,493. And when you come to option chain data, see you can see 18,500. And remember in Nifty actually they see here you can see a strike also it is written. So you just remember that in Nifty all the strike prices are available at a gap of 50 points. So suppose if Nifty tomorrow opens around 18,000, around 530, like here near this resistance level of like 537 or 540 like that, then the strike price if we are going to going long, then we have to choose 18,500. Example, I'm saying 550 as our call option. And this is last traded price. This whatever you are saying, this is our actually premium what we are paying to buy the options. So it any options, suppose I will just mention here 18,500. So there are various types of expiries also available. So first you will get is this month. This is 18,500 C is this month expiry like December. So every week Thursday is the expiry day. So for this option strike price 18,500 December strike price, the expiry day is, so this month's last Thursday, that is 29th of December. 29th of December. So similarly, there are various weekly expiry options are available, and weekly expiry is usually what we prefer to trade because they are available at lesser prices. You can see if I add all these. See, this is 15th December. So next week expiry 15th December. Expiry strike price option. So this is available at 100 rupees. If you see month end option for December for 18,500 C means it is around 234 rupees. So since we are intraday traders, so we are not going to hold any overnight positions. In such situations, we can buy cheaper options, which helps in reducing our trading cost actually. And in options, actually, the whatever the price you saw for the respective strike price, if you see for month end strike price, the price is higher, and weekly expiry strike price, the option price is the premium is lower. That is because of these option Greeks, which I have. That is because of this option Greeks. So there are majorly four option Greeks in any option. Let it be call option or put option. So the first option, like whatever you see, option Greek is delta. Delta is nothing but it measures the rate of change of options premium based on the directional of movement. Suppose the market is now trading at 18,500, and if you are going to buy any option, if you are long, if you are thinking you are bullish for the day, if you are going to buy a call option, if you are going to buy at the same level 18,500 call option only, then your delta will be around 0.50. I will explain again once I explain this option Greeks. Then also I will explain on the option chain also, like how you can see this delta value and other details also. So and the next option Greek is gamma. It is nothing but rate of change of delta itself. So does gamma is majorly used by actually option sellers, and also Vega is nothing but again rate of change of premium based on change in volatility. So this Vega defines the volatility of any option, and this is also again for option seller. If the Vega is higher, then it is not good for any option seller, and if the Vega is low, then it is good for option seller. And the fourth option Greek is theta, which is very key for any option buyer. So theta is nothing but the measurement of the time. Like theta is based, if you saw the example of 18,500 CE for the weekly option, 15th December was around 100 rupees. And for the month end option, like December end option price for 18,500 CE, it was around 234 rupees. The only difference between the price in options premium is only because of theta. Theta is nothing but time. As the time nears, like weekly expiry means the coming 15th December, then this is which is next week. In just 3 to 4 days, we are that option strike price is going to get deleted or eliminated. So that is why means which is having a less time. So theta is very less. So that is why the option premium is less. So whereas the month end we have still another 20 days left in the expiry. So that is why the option premium is higher. So theta is nothing but it measures the impact on the premium based on time left for the expiry. So for any option buyer, actually theta is the biggest enemy, and that is why while in trading also we need to select a strike price very wisely to avoid this theta decay impact on our trading, because for option buyer, do remember, for an option buyer always theta is the biggest enemy. And if the market, after taking any entry in our trading, if the market remains sideways, then definitely that because of theta decay, because of time decay, we our option premium starts decreasing before reaching hitting our target. And in such situations, we our stop loss gets hit and we end up losing money. So that is why a lot of people also say that options buying is very dangerous, this that at all, it's difficult to make money in option buying and all. But that is only because they will be not having much knowledge about these option Greeks and all, like to avoid any theta decay issue, which strike price we should buy, and all those details they will not be having. And that is why they feel that option buying is very risky. But if you watch this video till the end, I have explained like which strike price to buy and how to mitigate this theta decay issues and all. And also along with in this, since it is going to be a little bit bigger like the video, so I have decided to split this option options educational series into several parts. But if I get a good number of subscribers, then also I will be explaining in the next series, like how to put stop loss in options, and how to avoid theta decay issues, also with some risk management rules and all, which I teach to my webinar students. I have decided to discuss on my channel also. If I get enough number of subscribers and also likes on this video. This is our Nifty option chain data. Here you can see, if you go to settings, here are the Greeks. Since I am purely an option buyer, I have chosen only delta and theta, and gamma and vega I have not activated it because I am into purely option buying. If you see here, you can see theta, which is for the time decay, and if you see here, the delta, which gives the percentage kind of the rate of movement at which the option premium is going to change. So I will explain delta. Theta is, now you might have understood, like it depends upon the expiry day, and the and also the option strike price, as it comes close to the expiry of its respective expiry date. Because of theta, the premium price starts decaying. So now coming to delta, now the market, the Nifty is around 18,496. So around, means the closest strike price is 18,500. So the delta is around 0.53, means zero point 0.5. So suppose tomorrow market if opens around same level, around 18,500, and example is again market opens around this same level, and if you think the market is going around 18,560 or 600, and if you are going long, then if you decide to buy strike price which is at 18,500 only, then your delta will be around 0.53. So in this, suppose if market goes from 18,500 to around 18,550, then what will happen? The premium, which is now at 18,500, if you are going to buy, it is at 100 rupees. So if it reaches 550, 18,550 level, as you thought the market is going to be around 18,550, as per your analysis, if the market goes till 18,550, then the 100 rupees premium will become around 125 rupees. Why? Because why 125? Even though Nifty has moved 50 points, it has moved from what, 18,500 to 550, but your options price is around 100 rupees. The premium what you paid to buy 18,500 C is around 100 rupees, and once it moves to 18,550, your this option premium will be around 20, increased by 25 rupees, means it will be around 125 rupees. Why? Because your delta is around 0.53. So whatever, like 50 rupees movement means only 50%, because of delta, only 50% of the price will increase in the premium. So the 50% of this 50%, how I calculated is like based upon delta. Suppose if you choose, uh, even the market is at 18,500 level and you are going long only, if you choose 18,450 CE, see, if you see here, the delta is around 0.60. So in such situations, if the market goes from 18,500 to 550 also, but you have chosen to go long with the 18,500, 18,450 CE, then if the market goes from 18,500 to 550, the number of points captured in spot chart is 50 points, and your option premium what we have paid is around 130 rupees, means for the 50 points movement in 18,450 CE, your price will go up by around, your price will be around 160 rupees. Why? Because it is delta is zero point 0.6, so 50 points it has moved. So 50 for 50 points, 60% of that 50 points will be 30 rupees. So that 129 rupees will become 160 rupees. So this is how this delta is it measures the uh, ratio of any option price, option premium, like any increase in the spot chart. Spot chart means this Nifty chart price movement based upon delta, the price will vary accordingly the premium. So for an option buyer, out of four option Greeks, we need to focus on two Greeks, that is theta and delta. I think I have already explained. And also for an option buyer, the theta is the biggest enemy, which I have already emphasized on a lot. And based on delta, the option type is defined. You saw the delta value, which was around 0.53 for 15,000, 18,500 CE, and zero point 0.6 for 18,450 CE and all. So based on delta, we define the what type of the option. Suppose if the delta value, approximately delta value is around 0.821, then we call it as deep ITM. ITM means in the money. Suppose if the delta value is around 0.6 to 0.8, then we call slightly ITM, slightly in the money. And suppose if the delta value is around 0.45 to 0.55, then we call it as at the money ATM options. Suppose if the option price is suppose if the delta value is around 0.45 to zero point 0.3, then we call slightly OTM. OTM means out of the money. And deep OTM is again very zero point 0.3 to delta value, like deep out of the money. Now just note it down if you want. ITM means in the money, ITM means at the money, OTM means out of the money. So coming to next slide, which strike price is best to buy? So what I use is I prefer buying options which are slightly ITM. Slightly ITM means you can see here, which are having delta around 0.6 to 0.8. So buying slightly ITM options is safe as per me, based on my experience and based on my trading style also, since I am purely option buyer. Because slightly ITM options helps us in beating theta decay issues. Suppose if the market gets stuck at the same level, if I have bought any ATM option, at the money option, if the market gets stuck at the same level, then because of theta decay, my my stop loss on the option charts will get hit. But whereas on the spot chart in Nifty, my stop loss is not been hit. So in such situations, to avoid this theta decay issue, or when the market goes sideways, what I prefer is going slightly ITM option. With going slightly with ITM options is safer, which helps in beating theta decay to a certain time. Not always it helps for always. If the market is stuck for around, suppose around 30 minutes or around 30 to 40 minutes or something like that, then we can buying slightly ATM options helps in beating the theta decay. So again, this slightly ITM option or ITM options are not always helps in beating theta decay. That is why I have some other rules also, which I have made for my risk management, which I teach to my webinar students also. So if, coming to this, is just I have put an example in this year. Suppose if Nifty is trading around 17,500 level, then for going long, I what I prefer is I buy 17,400 CE, and for going short, what I do is 17,600 PE. So market is 17,000, around 17,500. So if the market is around 17,500, I will just give you how to decide which one is ITM, how to decide ITM, OTM in call option and ITM, OTM in put option. Suppose now this is your 17,500. So you are going long. So long means whatever the 17,500 and below levels, these are all come into the ITM options like 17,450, 17,450 or 17,400. These are all are ITM options. Suppose if the market is around 17,500 again, and if you are short, if you are going to take a short trade, then whatever the above like 17,600, just delete this. So whatever the above this will be your slightly these will be 17,600, 700, 550. These will be your slightly ITM options. So this is how I prefer trading in options with choosing the slightly ITM options. So this is all about basics of options and which strike price to buy and how to do index trading with the help of options. So thank you all. Thank you for watching my video. To make such more videos like this, I request all of you to share my YouTube channel link with your friends and relatives in the other groups, and also to like, comment, and subscribe to the channel. Thank you.